Nihat Ahmed, and I welcome you all back to this 6th video series, and this is the 4th video of this series. And in this we will be talking about the accounting cycle and the accruals and deferrals in it. So in this session we will explore the role of accruals and deferrals within this accounting cycle. So these concepts are vital for ensuring accurate and meaningful financial reporting. So accruals and deferrals are closely tied to the adjusting entries which are performed at the end of a particular accounting period. And adjusting entries help businesses align their financial activities with the particular accounting principles, which may be the realization principle or the matching principle. So these principles they dictate that the revenues should be recognized when they are earned, and the expenses should be recognized when they are incurred. So the need for these adjustment entries is because businesses span multiple accounting periods, and there are certain expenses or revenues that are prepaid or that are in advance. For example, a company might pay for the service of insurance for 12 months or 12 years. So a company will have to recognize all of these entries as adjusting entries at the end of each accounting period, and this will go on toward at the end of until the end of all of the prepaids or advance have been incurred or they have been earned. So let's move on to our next slide, which is about the introduction to adjusting entries. So now let's begin understanding the adjusting entries and their role in accounting. So adjusting entries are special journal entries that are made at the end of accounting period to ensure that the financial records are accurate and they reflect revenues and expenses for that particular period. These are essential for applying matching principle and realization principle. The matching principle ensures that expenses are recognized in the same period as the revenues they help generate. Moreover, the realization principle states that the revenues should be recognized when they are earned and irrespective of when they are received. These principles are fundamental in accounting, and they are based on accounting principles that are based on towards explaining the financial performance of a particular organization. So let's move on to our next slide. In this slide we will talk about why adjusting entries are needed. So adjusting entries are crucial for financial reporting. The main reason lies in the nature of business transactions, which often span multiple accounting periods. Many activities such as insurance contracts, magazines, subscriptions, or employee wages, they don't align perfectly with the start and end of a single accounting period. Without adjusting entries, these financial reports would fail to reflect the true or actual financial performance of a particular business. So adjusting entries are necessary to ensure compliance with the time period assumption, which divides a business financial activities into consistent time periods. These time periods could be months, they could be quarterly, they could be yearly, and they could even be monthly. So this assumption enables stakeholders to evaluate financial performance and compare it over time. So take for example a business that pays 12-month insurance premium upfront on January. If this entire expense is recognized in January, the monthly income statements for the rest of the year will be artificially inflated. Adjusting entries allocate the expense over the policy's duration, ensuring each period reflects its share of costs. Then we move on to next slide, which is about the types of adjusting entries. So adjusting entries fall primarily into four categories, each addressing a different type of transaction. Let's explore these in detail. So first is converting assets into expenses. So this occurs when an asset like a prepaid insurance or supplies or salaries or supplies is gradually consumed over time. For example, if a company pays for a year-long insurance policy upfront, the cost is to be expensed monthly as the coverage is utilized in those particular months. So adjusting entries ensure that the expenses align with the period in which they are benefited from. The second type of adjusting entry is converting liabilities into revenues. After these are also known as the unearned revenue, and this adjusting involves recognizing revenues for services or goods that have been partially delivered. For instance, it is the business if the business receives a payment in advance for a particular subscription, the revenue is initially recorded as a liability. So adjustments allocate the revenue to each period at the service is provided, in which service is provided. So the third type is accruing unpaid expenses. So expenses that have been incurred but not yet paid, such as wages or utility bills, they fall into this category. An adjusting entry ensures that these costs are recorded in the correct accounting period, even if the payment is made later. So the fourth and final type is accruing the uncontrolled revenue. So adjusting applies to revenues earned but not yet received, such as interest income or the fees for services rendered. So adjusting entries ensure that revenues is recognized in the period it is earned. So these were four types of adjusting entries. Let's move on to next slide. In this slides, let's focus on accruals, adjusting for accruals. So accruals are one of the most crucial adjustments made during the accounting cycle. Accruals involves the recording revenues or expenses that have been earned or incurred but not yet received or paid. So these adjustments ensure that financial records accurately reflect a business's performance within that particular accounting period. So there are two key types of accruals. So one is accrued expenses and other is accrued revenues. So accrued expenses are expenses that are incurred during a particular period but not yet paid. For example, wages for employees who have worked in December but who are paid in January must be recorded as a expense in December. Without these adjustments, financial statements would be not be accurate. Second type of accruals is the accrued revenues. So these are the revenues that are earned during a particular period but not yet received. For instance, a company providing a service in December but invoicing the client in January should recognize the revenue in December. This adjustment ensures that the revenues align with the period in which this service was provided. So let's move on towards our next slide, which is about adjusting for deferrals. So now let's move on to deferrals, which deal with cash transactions that occur before the associated revenues or expenses are recognized. Deferrals ensure that financial reporting reflects the actual timing of an economic activity. So rather than the timing of the cash flows, there are two main types of deferrals. First are prepaid expenses, and then there are unearned revenue. So prepaid expenses are expenses that are paid in advance, such as rent, insurance, or subscriptions. When a business prepays for a service, it initially records the payment as an asset. Over time, as the service is consumed or the good, the expense is recognized. For example, if a company pays for a 12-month insurance policy upfront, an adjustment entry is made each month to transfer 1/12 of the cost from a prepaid expense account to an insurance expense account. So the second type is unearned revenue. This occurs when a business receives the cash in advance for goods or services but are not yet provided. For example, a magazine company receiving annual subscription payments records the cash as unearned revenue, a liability, and that was this slide. So let's move on to our next slide. It is about depreciation as an adjusting entry. So depreciation is a specific type of adjusting entry that spreads the cost of a long-term asset over its useful life. This adjustment is essential for accurately reflecting the usage of an asset and ensuring compliance with the matching principle. When a company purchases a long-term assets, the machinery or equipment, the cost is not immediately expensed. Instead, it is allocated over the asset's useful depreciation expense. So that was this slide, and let's move on to our next slide. So what are the main characteristics of adjusting entries? So they have adjusting entries have a dual effect. So these entries affect income statement as well as balance sheet. So one entry will affect the income statement and the other will affect a balance sheet account. So they are also non-cash transactions. The cash is not exchanged. They are more of an internal adjustments of the already existing accounts. They kind of manage those accounts, but not any transfer of cash. So the next slide is about preparing the adjusted trial balance. So it is the new. This is the making of new balances after an accounting period has been completed, and all of the accounts will be updated in this trial balance, and it is for the end of a particular accounting period. So let's move on to our final slide, which is about adjusting entries and ethics. So ethical practices are very important in businesses, because business is responsible for various stakeholders' interests, and they have to protect those interests based upon their contribution to the company, because it is integral that company maintains its integrity. And that was it from this session. I will see you in the next video.